Please, come in.
A father had 3 sons, Mike, John, and David. One evening, you call them into your office.
Have a seat, all 3 of you.
Without saying a word, you place a large briefcase on the table. You slowly open it. Inside, $1 million in cash. The room goes silent. You divide the money equally. $1 million for Mike, $1 million for John, and $1 million for David. Then you give them one simple challenge. I'll come back in 5 years. Invest this money however you want.
Only one of you can lead this company. Show me that you have the vision to handle it. Earn this legacy.
When I return, we'll see who made the smartest decision. 5 years later, the results shocked everyone. But before I tell you who won, you need to understand why. Millions of beginner investors fail before they ever make real money. Most people believe investing is about finding the next Bitcoin, the next Tesla, or the next company that will explode by 1,000%. But that's not what destroys portfolios. Emotions do. Think about it. When do most people buy Bitcoin? Usually after it has already doubled. When do they buy a hot stock? After every influencer on YouTube starts talking about it. And when prices finally begin to fall, fear takes over. They panic, but they sell. A few months later, the market recovers. But by then, they're already gone. The market didn't beat them. Their emotions did. No.
Mike loved excitement. The moment he received his $1 million, he invested almost everything into crypto. The first year, it looked like Mike had made the perfect decision. His portfolio doubled, then nearly tripled. Everyone thought he was a genius. He bought a luxury sports car, posted screenshots of his profits. It is all about leverage, and everyone wanted his investment advice. But then, something changed. Bitcoin started falling, then Ethereum, and soon, almost the entire crypto market collapsed. Mike kept telling himself, "It'll recover. I just need to wait." But every morning, the numbers were even worse.
Eventually, fear took over. Mike couldn't take it anymore. With shaking hands, he clicked, "Sell all."
5 years later, his portfolio was worth around $700,000. Not because crypto is bad, but because he treated investing like gambling.
John had a completely different strategy. He believed he could beat the market. Instead of buying hundreds of companies, he carefully picked only a few. Apple, a fast-growing AI company, an electric vehicle startup, and another company everyone called the next Amazon. When the market shifts, only the disciplined survive. His strategy was about to pay off. This is what conviction looks like. Growth is slowing faster than anticipated. Markets are responding with a sharp downturn.
The economy slowed down. One company missed earnings. Another lost customers. One even filed for bankruptcy. Because John had concentrated most of his money into only a handful of companies, his portfolio suffered badly. 5 years later, he had around $850,000 remaining. John wasn't unlucky. He simply underestimated how risky individual stocks can be. Even professionals struggle to consistently pick winners.
True investing isn't about the chaos of day trading. It's about patience, discipline, and visualizing the long game. Instead of chasing the next big winner, he invested in a broad market ETF. His brothers laughed.
That's too slow. You'll never get rich doing that.
But David never stopped investing. During market crashes, during bull markets, he stayed consistent.
Five years later, David quietly opened his investment account. Balance, $1.45 million. No viral success, no overnight fortune, just steady growth, patience, and consistency. So, who actually made the smartest decision? Mike experienced the biggest gains, but also the biggest losses. John tried to outperform the market, but concentrated too much risk in a few companies. David accepted slower returns, but built wealth steadily without unnecessary stress. Does that mean crypto is always bad? No. Does that mean individual stocks never work? Absolutely not. Many investors have built fortunes with both. The real lesson isn't that one investment is magically better than another. The real lesson is understanding risk. If you're just starting your investing journey, ETFs are often the simplest place to begin because they provide instant diversification. As your knowledge grows, you can add carefully researched individual stocks. And if you believe in the future of cryptocurrency, keep it as a smaller part of your portfolio. Never money you can't afford to lose. Successful investing isn't about chasing excitement. It's about staying in the game long enough for compound growth to work its magic.
If you enjoyed this story and want to become a smarter investor, subscribe. We'll uncover the 5 biggest investing mistakes, and mistake number 3 might be costing you money without you even realizing it.